All right, everyone. Sorry we're running a little bit late here. It's 4:30 Eastern Time on January 31st. Great to have all of you with us. This is our first webinar of the year. I'm very excited to share with you our program called the Spread Trader, and with us is our Spread Trader extraordinaire. It's Sam DeMarco, and he is going to talk about some of what he does with our Spread Trader program. I'm going to talk a little bit about it as well too, and do a little bit of an intro here. And basically, um, what we're doing with Spread Trader here is trying to introduce a way for all of you to learn how to maybe take a directional play or a calendar play and mitigate your risk on a play. So we had a day like today where the S&P 500 lost close to 1.7% on the day. It was a pretty substantial loss today. The NASDAQ almost 2%. And, some people are probably scratching their heads wondering, well, hey, you know what? Alphabet with earnings out last night, AMD with strong earnings, Microsoft, a couple other companies out here. Why is the market going down, right? And we have to understand the markets. That's what they do. They go up and down, right? Over a long period of time, they go up a much further than they go down, and there are blips in the screen and so forth. If you look at a long-term chart, but in the meantime, you got to deal with what? You got to deal with the short-term volatility, and the short-term volatility is difficult to manage, especially when you're trading with options. However, we found a solution to counteract that, and it's spread trading. And Sam, as I mentioned, is an extraordinary trader and spread trader, especially. And he's going to talk a little bit about what he does in a few minutes. And we're going to, there's so much to cover with spread trading. And so we are going to have another webinar in about a month on February 28th, and talk a little bit about how to manage risk. And we haven't scheduled them yet, but we're going to have probably 2, maybe 3 more webinars talking about spread trading and trying to keep you guys engaged, keep you all interested in what's going on here. So I'm very happy to be here today and happy to talk about this. Sam had some extraordinary results last year. But here's what we're going to talk about. Here's the slides here. Now, here's what we're going to learn today. We're going to talk about credit spreads. Now, Sam does not just credit spreads, but also debit spreads here. We'll talk a little bit about that, why we use them, how to create a consistent stream of income, different risk levels, of different types of spreads, and how we utilize credit spreads. So basically what the question to ask you is, what are credit spreads? Well, options as they are as they were created were meant to be what's called a wasting asset, right? What does that mean? It means it expires. Think of a carton of milk, okay? It's got an expiration date on it, right? You go to the grocery store, you buy a carton of milk, stick it in the refrigerator, and you use it as quickly as you possibly can. And as you get closer to that expiration date, it starts to turn sour, right? And then you have to throw it away. Options are the same thing. As you get close to the expiration date on an option, it starts to decay, much like a milk it starts to decay. And while you can't taste an option, it's certainly going to sour and it's going to expire worthless. Now, there are different ways to play options. You can be a net buyer, or you can be a net seller, or you can be both at the same time. This is where the spread trading comes in, where you can be both a buyer and a seller simultaneously. They say 80% or more of options expire worthless, which is great. If you're a seller of options, you're going to make money 4 out of 5 times. It's great. Credit spreads offer defined risk, defined reward over an established period of time. So the keys to success for options trading are this: holding the spread open as long as possible. Sellers have decay working for them always. A plan where you take the trade off at a specific point. Knowing your volatility indicator for the instrument that you were trading. What does that mean? Basically, if you're trading oil, you got to know the OVX is the oil volatility. If you're trading the Russell 2000, then you have to know what the RVX is. If you're trading the SP 500, SPY, you got to know what the VIX is doing, right? You have to know where VIX levels are at, so you can create some spreads and take advantage of the volatility. And then finally, picking the right strike and selection. We always have a problem with that, right? That's not necessarily a danger sign if you can't do it. If you can't do it on a consistent basis, if you're constantly picking the wrong strikes, well, you're going to have a problem eventually. So there's an important relationship with the VIX, right? And its volatility is generally has an inverse relationship with the market. So what does that mean? It means when the VIX is going up like it was today, markets are usually going down. When the VIX is going down, we often see markets rising. It's an inverse relationship. So what do you want to do? What do you want to have happen as an option seller? Well, as an option seller, you like to be selling premium when volatility is high and it's starting to come down, right? That's where you're going to capture the most gains as an option seller. So when we hit those extreme levels, for instance, on the VIX, volatility index, we're not at extreme levels right now, but let's say we went to 20, 25, or 30, right? We know the premiums are going to be high because when volatility rises, it just simply means that the range expansion is increasing. In other words, it means that instead of going up and down like this, we're going up and down like this, right? Now, as risk-averse investors, most of us are, we don't like it when it's going down, when the market's going down. When volatility is expanding, we don't like it when the market's going down. We like it when the market's going up. But the pain that we feel mentally in our wallets or emotionally when the market's going down is probably 4 to 5x more than the joy we feel when the market's going up, right? So we often get sick to our stomach when the market's going down, like a day like today, and we just we were trying to go for alternatives. What happened today? It was just a bad day for the bulls. Give me a drink, right? If that's your poison. So it really becomes a difficult thing to do. But the challenge is to be able to look in and take advantage of the volatility and sell some of that premium. That's what Sam does with the spread trader. So extreme volatility increases returns on credit spreads, right? And recent high volatility around macro issues. Now, more recently, we haven't had too much of that around macro issues. Like we had this war in Russia and Ukraine. We've had some problems in the Red Sea, that sort of thing. That's going to increase the volatility because there's a lot of uncertainty there, and markets don't like uncertainty. Once that uncertainty, though, is removed, market direction seems to be pretty clear. And you go, the market's been trading as it has for the past 3.5 months, bottom left, upper right. You can certainly wait for those breaks to come in and start buying those dips. So there's a lot of people out there that I've just got a couple more slides here. A lot of people out here that talk about delta, right? Greeks, low delta. Jeff, when you're a seller of options, generally means higher probability because you have a lesser chance of getting to that strike, and essentially once it gets through that strike, if you're a short seller of puts, for instance, or calls, you're going to start losing money. So a low delta generally equates to a high probability. The lower the delta, the better the chance of 100% success. And I always like to look at delta in these terms. The delta is basically the percentage that the chance that option is going to get at the money before the expiration. So if you have a delta of, say, 7, it's about a 7% chance that it's going to get there. But you have a 93% chance, flip it around, right? 93% chance of it not getting there. So you've got better than a 9-to-1 chance of making full boat or making money on that trade. A lot of people don't like to buy puts. A lot of people don't like to play the downside of the market because it's just a short-term move, and I get that. But there are going to be times when you have to do it. All right, we have to do it, and some don't believe that bearish trades can make money in this market. We do, but we do it regularly. We added some puts today. Sam had some puts on as well. We often combine bear call spreads and bull put spreads. We're playing both sides of the market here. As long as short strikes are far enough away from the current strike, the trades certainly can be made viable. So last couple of slides here. Let's talk about risk here. Conditions for selling premium. Premiums are during or after a surge in volatility. Holidays are always a good time to sell puts, put spreads, because volatility starts to flatten in front of a holiday. It's not always like that, but usually like that. And remember something, a little word on risk. There's no free lunch in trading. We'll return to this slide at the next webinar on February 28th, but just wanted to let you know, high probability setups are considered low risk trading. There's always a headline risk that can create an adverse outcome. What does that mean? That means when something happens outside of the markets, maybe some news that happens, there's some that would be adverse to what the market's going to do. Like for instance, who knew what the Fed was going to be talking about today? Who knew that Powell was going to throw cold water? We sort of had, sort of thought he was going to say something to cool the jets of the markets. Fed funds futures were at 5 rate cuts. Now they're down to 4. So we'll see if that comes in a little bit more. We do not let but as far as losses are concerned, remember something, we don't let one loss wipe out all of our hard-earned gains. We manage risk, and that's something that we're going to be talking about at the next webinar. And we are proactive and ready to move if the market conditions change. The thesis for the changes, trade prices become extremely unstable. The last thing I'm going to talk about here is the importance of risk management. There are no guarantees in trading, but this system that we've put together, that Sam has built, has demonstrated a high degree of success since the beginning. It is a high probability, low risk strategy demonstrated with amazing results, nearly 5.7% return since a month since 2019. Yet when a trade is not working, you know what? We'll blow it out. We'll say it's not working. Remember something: trading is not a game of perfect here, and trading is all about playing the probabilities, playing the odds that are in your favor at all times. Things are going to happen where we're out of your control, right? But we accept those the outcome. We accept the results, and we move on and find the next trade. All right. Without further ado, I'm going to introduce Sam. Sam DeMarco is an extraordinary man. He's a brilliant guy who he's a teacher, he's an educator, and he loves to teach what he knows and what he does. He's been with me for a long time, and I'm extremely proud to have him by my side as we move forward. He's an extraordinary trader and has got a mind that I don't think I've seen anybody with the mind that Sam has had. He's brilliant. And he's there to share his wisdom with all of you. So without further ado, Sam, go ahead, take it away.
Thanks, Bob. I appreciate the great compliments, and thanks everyone for coming today. So just a little bit about myself. I went to school for computer engineering, did that for about 15, 20 years. And then I went into the classroom and I taught math for 10 years in my giving back period where I was teaching high school math. I left that and I'm back to doing engineering and trading with Bob. So couple things. I don't trade every day. I always look at the math and I'm always looking at the Greeks. And I've always hated, I guess I shouldn't use the word hated, but I've always disliked theta on longs. I always hated buying a long call and then watching it decay and not work properly. That always irritated me. So I use credit spreads and debit spreads. I like to mix them up both. I've seen a lot of messages lately from people. We've had a lot more interaction with the Spread Trader where people don't like the credit spreads with puts as much because they typically, when they go under, you can get put the stock. So I'll probably make some adjustments and use some call spreads on that, or I'll give you guys both the options of which trades you can use. As far as risk goes, I like $5 wide spreads. I use them mostly. And I also like the risk one to make one idea, whereas putting out a risk for 250 and you can make 250. And also slow and steady is the pace. You need a lot of patience to trade spreads. Oftentimes the spread is made or lost in the last day in a lot of cases, and that is because of the theta and how spreads work. So patience is a key on doing spreads. Okay, next one, Bob. All right, so some of the benefits on the spread trader, it's always a defined cost and risk. And I like to be able to put trades out there, since everybody that's trading has a different size portfolio. I like to put trades out there that are between the $2 and $5 range. This way, your max risk can be $200 and $500 on the low side, or you can put on as many contracts as you want to get that risk or reward up higher. So that's what I try to do. The spreads that I use typically require a smaller move to win. There's much less theta decay. There's not zero, but there's much less than in a regular call or a long put. And we've just started this new this year, about 3 weeks ago. We started a spread trader channel that is part of Slack. And that's where people who are interested in spread trades and part of the spread trader program can come in, see the posted trade. They can ask questions, discussions. You can get a spread education there with that. So that's really good stuff. I think Bob's got it up on the screen right now. I've had a lot of interaction in there in the last week. I've done a lot of posts, and it's been great to get everybody's feedback and stuff in there. So that's been a huge win for me to get things back for you. A little bit about 2023, closed out the year at 19.8% for the year. But I think the more important thing is the max risk that I used, that I had as my goal, was 15% of the portfolio at any given time. Now, typically, I go with 30% of the portfolio. But last year, being more a bear market and a lot more volatility, I took that risk down to 15%. So that means I had on at most, if the portfolio is worth 100 grand, at most, I had $15,000 at risk in the market. So if I was to lose every single trade, 15,000 is the worst that I could lose. So that's kind of my goal, where I'd like to trade at. I'll probably increase that a little bit this year if things stabilize up to 20 or 25%. But right now, that's pretty much where I sit on my risk factor. All right, Bob, next one on theta decay. Okay, so theta is basically the decline in value of an option over time. Everything you buy will decay, and over time it goes down to zero. So kind of hard to see this, but I like to sell premium with call and put calendars. I do mostly call calendars. And this is an example of one that I posted in the room, in the spread trader room. Bob bought a March 160 call probably about 6-7 days ago. And that call immediately shot up. He paid like $6.50 for it or something, and it immediately shot up to $7. And I was pretty irritated with that. So I said, well, I'm going to sell a 170 call. And I think I collected about $1.30 for that 170 call, so that I didn't have to pay as much for that March call. And what's happened since then, I got a big picture of this trade coming up later on. You'll see that it's the sold call that's actually making the money on that trade right now. The March call is actually red, but the February call is actually quite green. So that's a lot of things that I do. All right, another thing about spread trade on the types. Next slide, Bob. Okay, so calendar.
Sammy there? Did we lose Sam? Well, let me pick it up. So, you guys can all hear me all right. So basically, a couple of different trade types that Sam likes to do. One is a calendar. What a simple calendar would be if you go long a dated call and then you sell a shorter dated call against it, but it's the same strike, right? So he talked about Apple here and Meta. So Apple trading at about $185. Oh, there's Sam. He's back. I started thinking about the calendar for Apple. Go ahead.
Oh, good. So is there any way we can make that a little bigger?
A little bigger. Yep.
Maybe put it in slideshow mode.
Let's see here.
Okay, well, in the Apple call, I'll go bring it up on my screen so I can get the actual numbers.
Did it work? No. Hang on a second here. 1 minute here.
Okay. So in the Apple situation, what I did is I'm long a May 190 call. Okay, or I'm sorry, a March 190 call, and I paid this dang thing.
There we go.
Okay, and I paid almost $7 for that. And what I did is I sold against it, and I sold a February 200 call. So by doing a 190 200, that means that the profit is limited to that $10 because that's the width of those. So this is what we call a diagonal, and my net price in there is $5.49. So limited to $10, I can make $5 on this trade, which is still a double. Okay, so I like to take the trades off when I get a nice double in there. So in this particular case, by selling against it, I kind of bought myself a $1.37 worth of insurance. And so that's the way I look at these sold calls against it, is some insurance against this thing, Apple going down. And sure enough, you know, today Apple's gone down, and this call that I sold for $1.27 is now worth 29 cents. So I got $1 worth of profit in that, and so I had $108 of profit, and I got a $135 loss. So overall, this trade, I'm down $27. So that's not bad for a day like today to only have one of your trades down $27. That's pretty much where I like to get these things sitting on that regard. So I really strive to do that with the risk. Okay. So another one, this is a trade that's still going. Next slide, Bob, is this one is Meta. Okay, so what I wanted to talk about here is I put on a spread in the Meta spread trader. I bought the 190, and then I sold. I'm sorry, I bought the 390 and sold the 397 call against it. But this one is because of earnings. So before earnings, you also notice that every time earnings come out for a stock, the options closest to that earnings date are very expensive. So what I do is I sell that expensive call and I buy a less expensive call on a longer date. So that's what I did here. I bought the February 9th and I sold the February 2nd. And I paid about $5 for that on a $7.50 spread. So in this particular case, I can make $2.50 on it. Except what's going to happen is because of the inflated price of that earlier call, okay, I'm going to make a lot more because that earlier call has a lot of volatility in it. And as soon as Meta announces their earnings, that volatility is going to go to zero. And that call price is going to drop just down to the intrinsic value. And so you basically earn all that and you keep all that in the cases. And then the other thing I do a lot of is we had a big discussion on this in the spread trader room was I did a simulation here. This is using Fidelity, but I did a simulation with adding two other call spreads, one at the 430 point and a put spread at 390. And what that does, it widens out the curve. If you look at the top part of this graph, that top part is where you're making the most money, and then it drops off. So if you look at the bottom table here, this trade is green all the way from 370 all the way up to like 450 or something. So if Meta closes in that range, I'm going to make something. So I like, and this is all because of the volatility, all because the volatility of what's going to come out in those days. So this is how the market makers make their money. You know, they put a lot of volatility in there, takes out a lot less risk for them. And so I'm turning that around and selling that to make an advantage. So these are one of my favorite trades to do at earnings time. So next one, Bob.
Hey, Sam, I had a question for you. So on this graph, what is this purple line now?
The purple line is those are the graphs are based on dates. So the purple line is on the 29th. So when I created this graph, I think I created it on the 29th. Okay. So the 29th represented the current level of profitability of that trade. Okay.
Does everybody see that? Everybody see that current profitability of the trade?
That was the blue line.
The blue
line. There's no orange line because that's also the 29th. If you look on the far left there, you'll see the dates down at the bottom and the table right there. And then the blue one is what happens on February 2nd. So this tool that I use, that's part of Fidelity's tool package with their active trader, it does the math for me and tells me where these things are going to be. It's not where they're likely to be. Okay. This is, I mean, it is still based on probability, but it says if it's at this $375 price, okay, that's the leftmost green column, I'm going to make $385 on this trade.
Yeah.
Okay. That's, and I have used this tool and I can tell you it is accurate.
And so we know that Meta's got earnings coming out tomorrow. And what do we know when in front of earnings, what do the option market makers do? They juice it up, right? Implied volatility is going to rise. Why does implied volatility rise? It rises because expected moves are based on historical outcomes, historical references, right? So if you're making a market in this, right, and you're trying to make a fair market, and you know that every 3 months, every quarter, the stock makes a big move, you're going to price that option accordingly. Remember something, everyone: high volatility cuts both ways. It's up and down, right? So if the normal move for Meta on a normal day, $300, $400 stock is like $3, right? But on an option on a day when earnings are coming out or some special events going on, the chances are great of a much bigger move, maybe 2x that move. Well, the market maker is going to price those options at $9 instead of $3, right? So what Sam is trying to do is trying to take advantage of that and say, well, you know, look, I mean, if you're going to move the move the stock that much, then I kind of dare you to do it. And with the fact that time decay, when Sam is selling on the selling side of this trade, is in his favor right now. Does everybody understand that? So kind of roundabout. I took a long way for an answer there, but that's pretty much basically the gist of it. All right.
Okay, so let's. Everybody asks me, okay, spreads versus long, right? You know, Bob does the EO directional trader. Why would I do spreads? Okay, so let's compare, and the answer comes down to risk, right? It comes down to what you're comfortable with. So I just did this trade. This was a Costco trade. I bought a March 700 call and I sold the 705, which gave me a spread. The cost per contract of that was $2.50 or $250 for one contract. The long call, if you just bought the long call, was $22.50. Okay, so that's $2,250. So you have a almost a 10x investment for one contract. But let's look at some characteristics. Let's look at the break even. First off, the break even of the spread trade is with Costco at 702.5. because that's what I paid. I paid $250. The break even of the long call is $722.50. So Costco's got to close $20 higher for the other one to break even. I can get a 2x return at 705, okay, for my spread. The 2x return comes at $745 for the long call. And so now you'll say, okay, well, you know, I can make much, much more money with 2x on 2250. That is definitely true. However, if you consider that 10 contracts of the spread cost you the same amount of money, okay, as the one long call, okay, now you can make the same amount of money. Now, granted, if Costco goes above 745, the spread trade is going to be capped out and the long call is still going to be going. But the spread allows you to control your risk in smaller increments. So that's what I really like about them. I can put on 1 contract, 3 contracts, 10 contracts, depending on my account size and what my risk tolerance is for that trade. In the spread trader, you will see that I put all of the trades on at the same risk level. It's about, in the spread trader, it's about a $200,000 account, and I put all the trades on at about 1.5%. So at about 30, somewhere between right around 3,500 is what I shoot for the risk on every trade, and I don't deviate. That's what I do. Each trade's worth 3,500 bucks, either win or lose, in those regards. So that's the way that you can control risk with the spread trader. Okay, and then on a day like today, let's look at what happened with one of the trades. So this was Amazon, and this is something I didn't make the trade in Spread Trader, but I posted in the room. And a day like today, this is that same call where I think the original purchase price was $650, and then I sold the 170 against it. This trade is
Whoops, we lost Sam there. So
okay, I figured it out this time. All right, so this time,
okay.
yeah. Every time my phone rings, it takes my headphone offline. So this trade is in the green right now, and it's in the green because of the sold call. So the 170 sold call is the reason that this trade has made money. And so, you know, we'll just keep that 170 call and still let it decay. Okay. It's a February 2nd one. It's still got, I think, about 30 cents worth of decay, or the way I like to look at it is another 30 cents worth of insurance on it. If I wanted to, I could roll down, but I like the $10 spread when I originally started it. I don't want to be greedy. Okay. And so there's an old saying with spreads, set them and forget them. So that's typically what I do with these. I don't make a lot of changes to the spreads. All right. So next, coming up, questions.
Any questions, everyone? Anyone? Please type in your question if you got one. Or I know, Sam, we're streaming on Twitter right now, so it's live right now. So we've got a lot of people watching it on Twitter too. So and even on LinkedIn and on YouTube. So that's great. Let's see.
I use for my platform, I use Fidelity's Active Trader Pro, and I'm on a Mac, so that's what I use as my trading platform for viewing for my stock viewer and stuff for charts and charting. I use TradingView. So there's not a lot of people that use TradingView, but that is the one that I love to use. The reason I use it is because it allows me to write programs. And in my next seminar that we do in 30 days, I'm going to actually show that program. I've written a back testing program where I can go back in time and see how spread trades have performed and that really helps with trends. So, and I use weeklies for that.
That's
okay. So,
not very many questions yet. I think you've overwhelmed everybody, Sam.
Yeah, there's a lot to think about, a lot of material. So I did this about a year ago, and I said clearly we were in a bear market, and this time I put bear or bull. I mean, I think we could debate forever what type of market we're in, but I think the key here is that times are different. You need to recognize it. You need to accept it. I've got a couple of rules that I've been following right now, and that's pretty much to run my calendars to the end. Okay. So for the March spread, you have to keep it until close. Yes, absolutely. You got to keep the spread. So if you're looking at that Costco spread, we're going to keep that till the end to recognize the full value. If you notice, if any of you are in Spread Trader right now, there's an Adobe spread on in there right now. And God, I think it's down at like 575, 585, and Adobe's at 612. I tried to close it yesterday for $9.50. I put an order in my broker. I said, close this thing at $9.50. It's a $10 spread. Never hit. That's because the market makers aren't going to let it close until it gets closer to the expiration. So I'll just keep monitoring that. Yeah, I love Adobe too. So I'm going to run the verticals. If I can get 90% or greater, I usually close them. But I'm not there with the Adobe one yet. So one thing I want to point out to you guys is on a day like today, I don't know, I'm looking at my account and it's had a 12 to 15% move. And it's not that I've lost that much money or made that much money. It is because the bid asks of all the options are wide. And when the bid ask is wide, Fidelity is horrible. They price it at the worst possible price. And so they'll price it and give you, I mean, the Costco spread last night in the Costco closed over 700 last night. And the spread trader algorithm priced the trade at $3.12. And I'm like, oh, that's ridiculous. It's over 700. Okay. And so what happens is sometimes things just get priced erroneously because of the volatility in the market. So you have to look at a lot of your trades. Like if you're in the Adobe trade right now and you look at it on Fidelity, it's going to say it's pricing between $6 and $15. Well, that's totally inaccurate. It's worth $10. That's it. So depending on how many contracts you have, it can really sway your total balance. Risk. And manage it. Like I said, I keep the value of each trade at the same level, the same risk. I use the spreads for theta decay. And every once in a while, I'll put on some puts. I don't do it a whole lot in the spread trader because the spreads by nature give us some degree of protection in there, especially when we have a lot of calendars on. Know that I do the exact same trades in my account. When I say I filled at $1.75, I filled at $1.75. I do the exact same trades in my accounts, so I live or die by my own trades as well. Futures or options. I haven't dealt too much with futures or options, but if there were some option contracts on cryptos, I could do some plays on those. We could look at investigating those. And do those as well. About questions and stuff, I'm pretty much available to you guys if you have questions. I have an email at Explosive Options. It's just sam@explosiveoptions.net. You can send me an email. You can hit me with a direct message in the chat room. I often get messages from a lot of you privately. Hey, Sam, I put on this trade. I'm wondering what my options are because it's not looking good, or it's doing this, or I'm getting close to my strikes. What do I do? I get those questions all the time. I'm happy to answer them, make recommendations for you guys, tell you exactly what I would do or what I wouldn't do. So please contact me. I think there's a lot more communication now that we actually opened the channel itself. I see a lot more people willing to put questions in there about spreads, probably because it's dedicated to spreads and only spreads. And that channel goes at a much slower pace than the EO chat. Okay. I'll let Bob field that question. Bob, the question was about the service model for explosive options, and it used to be 3 tiers.
Yep. Yeah. So thanks for that. And so basically, we have the explosive options EO directional service that I run, and then Sam runs the spread trader, and then we have the chat room. And so what we've done recently is we've added as Sam mentioned earlier, the spread trader channel in our Slack. I'll show that to you again. And this regular chat room. So if you get into the spread trader, you'll have access to this room. There's 170 people in the room now. Last week it was like 30, so we have 170 people now in the room. So we have a lot of other people asking questions and putting ideas in there. Sam is putting his ideas in here. This is from yesterday, and you can see some of the things that we did. And Sam's right. There's some videos that are available that he and I have done of training on for Spread Trader. That's also on the website. So we have the 3 different things, the 3 tiers, like you said, with the EO, Spread Trader, and then the chat room. And again, if you get the Spread Trader only, you'll get access to this. If you're in everything, you'll get access to the regular chat room as well too. But I wanted to share with all of you here what we have going on here today, and this is really important. So pay attention. So we started the service in September of 2016. So it's been almost a little over 7 years. Since inception, the spread trader's up 106%. Okay, so that's an average monthly return of about 1.2%. Doesn't sound like a lot, does it? But if I were to tell you, you could earn about 1.2% for very, very little risk, if any at all. So it's not a risk-free rate, of course, but there is some risk. Would you take it? I certainly would. That's an average of about 14% a year for the past 7 years. So you have to think about this for a minute and say, look, you know what? I mean, I do have some money that if you have some money that is taking on some risk, maybe in the S&P 500, on a day like today, when again we're down 1.7% on the S&P 500, that hurts. That is more than half the gains from the prior days of the month in January. From when the month of January started trading on January 2nd to today, the last trading day of the month, we were about 3%, 3.1% coming into today. We lost more than half of it today. That's brutal, right? But if you're in a service like this one, the Spread Trader, consistent service where regardless of what the market volatility is doing, Sam is putting you in its position to make money going up, going down, staying sideways. Well, you know, I mean, you can't ask for anything better than that. So let's assume an example out here. Let's say you had a $30,000 account when we first started in September of 2016, and you stayed with every single trade, notwithstanding commissions, of course. You'd have about almost $62,000 in your account. You more than doubled your account. Now you think, well, that's not that much. But when you consider that includes that massive crash that we had in 2020, March, right? We had trades going on back then. An investment for a 1-year subscription is $1,099. Okay, a 14% gain every single year for the last 7 years. Look how much positive you are. You're a $4,200 gain versus a $1,099 for the service for each year, right? So yes, in 7 years you would have paid about almost $7,700 for the service, but you would have made close to $3,200 each year on average. for a service that is offering you these kind of returns with very little risk to take. So why we started this back in 2016, because we identified a need for low risk income generating strategies. A lot of people out there said, "Hey, Bob, you know what? I'm tired of the ups and downs. I'm tired of the moves, big moves in the markets up and down. I can't get my arms around it, and it's just making me nervous." So I said, I get it. I mean, spread trading is a great way to mitigate a lot of that risk. It's a method of trading that gives you a high probability with that limited risk, right? We're all risk averse, I mean, if I had to take a poll and ask everybody who's watching this webinar, if I told you you can get 5 or 6% return with zero risk, I think everyone would raise their hand and say, yes, I'm there, include me, myself included, Sam as well. So in this service, you see our trades as they happen in real time. You'll have ample opportunity to get in and to get out. We have text messaging as well. And again, up 106% since inception. And not only were our trades up in 2023, up 20%, but for a very, very low level of risk, right? So again, it's a hands-on, tactically managed portfolio by Sam. We trade the service with a high degree of confidence. So far, we have produced really strong, consistent results. So let's talk about how this works. You sign up. I'm going to give you the link to sign up in just a moment. Instructions on what to do. You will receive email alerts. You can open up the SMS service, which is a text messaging service. You get blog articles, weekly webinar invites, monthly webinar invites, the daily bites every Monday and Thursday, and the Spread Trader channel on Slack, which is extremely valuable right there in and of itself right here. Okay, why is it so valuable? It's because you're probably sitting right next to Sam when you're in the room. He's right there, right next to you, helping you, holding your hand, telling you what to do. Why as you watch what he's doing. Okay. So what you get about 5. Well, he averages about 5 to 8 trades a month, give or take. Trade ideas are handpicked to minimize the market exposure. We'll use puts, we'll use calls, selling put spreads, selling call spreads, buying put spreads. You have an opportunity to ladder trades. Sam has done this a few times. It's a brilliant strategy. Access to our deep market knowledge and technical analysis. So I ask you if the cost is too much here. Okay, if you did just one trade collecting $130 each time on these low risk trades, your annual fee could be paid for in 5 to 7 contracts. I mentioned that annual subscription is $10.99, paid for in a month, maybe with only one contract, right? But hold on a minute. I'm offering everybody in this webinar, and maybe the next several days, a chance to get what's called a BOGO. When I was in the grocery business, we called them BOGOs. Buy one, get one. Buy one, get one free. And because you're with us today and spent time listening and learning to what we're doing, I'm going to take the Spread Trader and let you get a chance to test drive it, not for 1 month, but for 2 months at $109, which is the normal monthly price. You get it for 2 months and not one. You get the trade recommendations sent to your email box. If you're happy after a couple months, you can continue on at $109 a month. Last year's promo service, we had a promo last year. Sam was running it. It was on fire, absolutely on fire. Summertime. Remember that, Sam?
Yeah, that summer was that was a great period.
We booked several winners over the summer. We decided to do it again. That was a repeat from the prior year in 2022. Everyone who traded with us made some big time money. All right. So here's a chance for you to get going again. This is the Spread Trader BOGO. All right. Let me get that link up there for you. All right. Here's our regular link to the spread trader. This is their spread trader BOGO. All right. I will put this in the room in our chat. All right, let me see that here. Hang on a second. There we go. I will put this in the chat. The link is in there. Spread Trader BOGO, 2 months trial, $109. Fill that sucker out, and you'll start getting trade ideas from Sam within a couple of days. I suspect pretty soon. All right.
Hey Bob, real quick, there was a question about
Yep.
do I post exits for the trades? And yes, I post both the entries and the exits. One of the key reasons I got into trading spreads was that I worked full time as well, and it was really hard to get out of calls at the right time. I mean, and so that's why I got into doing spread trading.
Yeah, I mean, there's a lot of people, a lot of services out there. They don't hold your hand all the way through from the entry to the exit, which it's really not fair, right? I mean, how do you know if they're telling you when to get in and then all of a sudden they stop communicating with you? How the heck do you know when to get out, right? Obviously, we all have to have an internal risk management system in place, but still, if you're relying on somebody else to guide you in, they have to help you guide you out, right? And you can't front run people, first of all. Second of all, you have to help people get out of a trade, whether it's a winner or a loser or both, right? So I think that's the way it's always been, doing it the right way. That's the way Sam manages the service too. Any other questions? So everybody, this is your chance. Come on in. We're going to do another one of these webinars again next month on the 28th. I apologize for the technical difficulties and getting started a little bit late here today. We'll clean that stuff up by the next webinar, and I hope to see you guys all in the service pretty soon. And again, this has been live streamed on LinkedIn, YouTube, Facebook, and X. And it's great to have all you guys listening. And if you have any questions on anything, Sam's email is sam@explosiveoptions.net. I will put that in there. What room? Sam@explosiveoptions.net. So if you got any questions or anything for him, send him an email. He'll be happy to answer it for you. All right. Thanks all, everyone. I appreciate it. And we'll send you guys all a replay of the webinar from today. We'll send it out probably next day or two as well, too. Thanks, Sam.
All right. Take care. Bye, everyone.
Thanks, everyone.